Hello, ladies and gentlemen, and welcome back. Well, in 2022, it doesn't look like Santa is coming. And as we warned over the last couple of weeks, this is incredibly common during bear market years. But what's more important is what's just happened in the bonds market and what it means specifically for the Q1 of 2023. We've mentioned many times that earnings will be in focus, but is this a sell the rumor, buy the fact style situation? With some stocks such as Amazon almost hitting 2020 lows, we've got to discuss what happens next. Well, welcome back everybody to the daily show where we talk about stocks, commodities, and cryptos. We've got the lead indicators, the big news stories, the macro charts, and of course, the key levels that you should be watching throughout today's video. But let's just talk about the news stories. Stocks are sinking supposedly on, of course, fresh COVID threats to the world economy. We've seen the US now instigate checks for everybody coming out of China, and of course they're going to have to do testing. But more importantly, it's really about what's occurring in the 10-year Treasury yields. We're seeing those climbing up to the highest levels since November. We've got the key chart that I think a lot of you will need to be looking at very soon, but let's discuss what's happening right now with markets into 2023. The first one is, of course, Santa rallies. We know that if Santa Claus doesn't come to town, and there's only a few more days for him to do so, and we end up being red on the SP 500, it doesn't bode well for January or Q1. Very rarely does Santa not come, but in the last couple of years, he's been a little bit lackluster, and unfortunately, especially this year, so far, not so good. So the calendar year could be at stake, but more importantly, it's what happens in Q1 into earnings that I think is the biggest concern. We also do know as well that when the Nasdaq drops 20% on annual drops, that bad things can occur in the next couple of years. And we've discussed this in the last video. Percentage changes from 73, the first year of drop, ended up being a very bad year. Notice 74. From 2000, the first year of drop ended up being another bad year. So in 2001, that happened. And then, of course, we have the next couple of years. Now, you might think this is a 50% chance of drop, but if you think about it, the first year is where we're at right now. So if we're focusing on a 73 or a 2000 style scenario, then bad things might be there. And if the Fed can't support us like they did in 2008, again, you've got to be concerned about the portfolios and this nature of the market coming into 2023. Let's have a look at what everybody else is thinking. This is some of the top strategists out there. This is their 2023 targets. You already may know that most of these targets have been wrong in terms of their prices for 2022 so far, but most people seem to be liking around the current price for markets by the end of the year. There's a few that have called for 3,400, 3,650, and 3,725. And right now, if you're looking at it, you might think they're all mad. And they may be. They're actually not historically very good at picking these markets, but there, of course, are the picks that are going on so far. Now, we mentioned that high yields are becoming really, really desperate and very scary. We saw this a few weeks ago where we started to turn really bearish on the market after seeing the CPI switch. And we've shared this over on our Twitter, so follow at FX Evolution if you're interested. But basically, this is what we call a shooting star style weekly candle. We've noticed that a few times this has occurred where we've had some big drop-offs, either engulfing candles or shooting stars or some type of rejection island, and all of these have marked for very large moves in the S&P 500. In fact, they've been upwards of 18 to 20%. So what's happened in the last couple of days? Well, bonds in general have fallen off a cliff, and this is specifically because of the federal funds rate and what the expectations are. Now, with COVID lockdowns pretty much gone, but again now COVID breakouts becoming really, really high, there's a lot of concern in the market about what might happen next. Now, we could say that's just an excuse. We could say it's anything. But realistically, let's have a look here at what yields are telling us about the market. And you'll notice that from the early stages or the mid-late stages of December, things have changed a little bit. All of a sudden, while we're still seeing rate cuts coming through after hitting what we call the terminal rate, that is the highest federal funds rate that we should be reaching, then we see a slower cut. And this is effectively hurting bonds because, of course, bonds will perform better in rate cutting style scenarios. Just look how susceptible they are to these types of situations. Now, what's that telling us? Well, it's basically saying that it's going to take longer for the Federal Reserve to potentially combat inflation. They're not going to be able to support the economy as much, putting more pressure on specifically economical fundamentals. So we're talking about companies and their valuations. That's why we've seen such a huge sell-off in so many stocks. No doubt we have demand destruction, but it looks like the Federal Reserve may not be able to come back as quickly as possible to support the economies. So sometimes they say being out of the market is a bad thing because there are certain days in time that if you miss out on those big bull days, you end up ruining your account or your superannuation or your 401k. Here's the thing though about 2022. If you were trading 5 days, literally 95% of the SP 500 losses happened in 2022. September the 13th, an ominous day there. May 18th, June 13th, seems to be a lot of things around 13th, April 29th, and then of course May 5th. These were the big days, and you can see some of these percentage moves were pretty drastic. In fact, some of them upwards of 4.3% are some of the wildest kind of swings that we've seen in quite some time. It was the worst day since 2020 where we saw some epic swings, but it just shows you that being invested or divested during certain days can really make a massive difference to your portfolios. Let's now have a look at what Wall Street's really doing before we jump into the charts and look at the key levels. So specifically, we've got to talk about these big rotations we've seen in the last couple of days. Look at what did well over the last 5 days. Energy, utilities, financials, staples, healthcare. Most of these are inflation plays, which is things like banks and energy, and the rest are all defensive. What didn't do well? Semiconductors, tech, consumer discretionary, clean energy, and of course solar. Yeah, it was pretty much another rotation, and this seems to be the story that we've seen so far over the last month. If we have a look at the last month of results, it's a stagflation play out in the lead, which is gold, GDX. Then we have utilities, healthcare, staples, and the rest of them, with clean energy getting absolutely walloped 21.85%. This is a full-on valuation compression. And as you will know, if you've been watching the channel, subscribe if you haven't been, that 17 PE forward PE is one of the biggest expectations that the market generally likes to trade at. If we start to see that change, let's say we see a 14 PE forward in 2023, well, they know what it says to be fearful when others are greedy. And of course, in this case, maybe it's best to be greedy when others are fearful if you have longer term aspirations for the markets. Of course, practice your own risk management with those types of things. But this is one of the biggest things of 2023, valuation compression. It will be the story. Earnings, specifically Q1 and Q2. Make sure that you're watching, that you're well aware of what's going on in the markets during those times, and more importantly, that you have a plan. We always talk about having the ability to make plans around these specific periods. So let's jump into the charts, and we'll start off here with the VIX, and we'll talk about the volatility index. Now, as many of you would know, if it's above 20, generally it's a fearful style market. If it's below 20, it's generally a bullish style market. And we've seen again and again through 2022, around that 20 be purchased as the VIX, and then it usually riding back up to the level of 35. Now, I've superimposed the S&P 500, which is the orange line here, just to show a similar time where this happened before. And yes, it is going to be the GFC, the global financial crisis. We saw a lot of the VIX basically hitting a very similar point. If we go out to a weekly here, what you might notice is that during 2007, we end up seeing a lot of VIX 35s, and then all of a sudden it came down, it was pretty chill, and then it just spiked up with this almighty fear that came through. Will 2023 be that almighty fear level? So far it's on track. A lot of people are saying this, so usually it doesn't happen the same ways. History sometimes has a rhythm to it and rhymes, but it usually doesn't work the exact same way. This is something that we're looking at though, and while we're not probably expecting a high VIX as high as this was in 2008, we would love to see a VIX 45 plus. because once that starts to happen, you can be pretty close or pretty sure that you're fairly close to the bottoms. Usually that's where you get that maximum fear. And as Warren Buffett says, sometimes it's good to be greedy when others are fearful. Obviously, you've got to practice your own risk management. So we've heard about the bonds and the yields. We've seen those front year curves and what they're doing. They're going high, and then they're being cut at a slightly slower rate. That's really taking a massive effect on markets. US 2-year yield 4.34. These are going to continue to be a big thing to watch throughout 2023, and the 10 years gone back up to 3.869. So it's starting to get up there to almost its peaks. You know, we're only about 0.4, 0.5% away now from where it was. And this is coming off a 3.4 base. So you can see why the markets are not happy. Some people are saying that with the China opening up and obviously this COVID breakout that they're having, that we could see inflation again spike, kind of like inflation coming out due to shutdowns that are just caused by people not being able to work. And there's certainly some major concerns there coming into 2023. Specifically, they're going to hit, you would think, not only demand because of bad sentiment, but you would think also costs may again increase. And that's going to be the major concern that markets are looking at. If you look at the high yields, this is the live data chart of them. I've changed it to the daily just so we can see that we have similarities. An island, an island, and an island. 3 times we've seen toppings of islands and basically the rejection of those. This market is now ahead of the SPX, and make sure that you always have the S&P 500 basically overlaid. So you'll see here that the high yields are coming down. And if we take a percentage recently of them, you'll notice that they're pretty much in line. But this is something that's happened before where we've seen usually bonds should move a little bit slower in terms of raw percentage. So you kind of think like maybe a 2-to-1 ratio. And yeah, it's really started to gather some steam, especially in the last 2 trading days where we saw high yields weaken. We've also seen treasuries fall off. We did warn against treasuries up here. It's not that I don't like treasuries. I actually think treasuries are going to be one of the smarter plays, medium to longer term, but they were a little bit too cool. And when things are a little bit too cool, unfortunately, everybody is jumping on board. They kind of became their own meme. And we're back probably to what you would think is a fairly fair level. Generally speaking, you're looking for things like fib retracements into these points. Even though you don't really want to do too much TAing with bonds, usually they're more of a macro style play. You can see here about that 98.60 would be an interesting point, a 61.8 fib retracement for TLT. Again, very similar island style reversal, huge sell off here in treasuries. You'll need that US 10-year to turn around. These are 20-year, of course, treasury bonds. So we want to see US 10-year start to fall back off. And I'd say that happens. It's just a question of timing, which is the most important. Let's now have a look at what's going on with the US dollar futures. And they actually look pretty strong. We have been thinking US dollar is starting to accumulate or looking a bit better. Check out these wicks. So we just saw a nice closure where we've got basically these nice wick rejections coming off these lows. We moved above the 104 recently. We'll go down to the 2-hour to understand this market. And it really does look like some form of accumulation at this point. We've hit a critical bottom. We found big rejections off that level. We made a new kind of high. We pulled back to a 61.8 kind of fib, finding some buys again. Didn't show recommitment yet, kind of double bottoming here on this chart. And we'd love to see a 104, I think it's about 60 break. And if that happens, then we should be moving for the US dollar back into, you would hope somewhere upwards of at least 105, if not 105.50. You'll notice I've got an alert above 105 kind of 90. And the main reason is when that occurs, if it does, then we've got a bigger kind of trade on our hands that can go all the way to 107. And of course, you're looking to buy those dips. Now, this doesn't change the fact that, yes, the US dollar has been pretty negative in terms of sentiment recently. But even if you draw, no matter which trend line you get here, most times you're seeing them break through. So hopefully the US dollar continues to strengthen. But as we've seen before, that's not necessarily great for the US stock market. I don't think they're as synergized as they were, but certainly one to watch. Now, what's that putting pressure on? Well, gold has been interesting, to say the least. Gold broke and made a new high. Now, I've warned against this at this time of year. Gold tends to have incredibly large spreads going into the new year and specifically after Christmas. You've got to be really careful if you trade gold around these times. And if you go back to, I think it's about 3-4 years ago, and you have a look at currencies around the 2nd of January on your charts, pull up something like the odd US dollar, and you'll notice there was a huge move caused by illiquidity around these times. Be very careful around this period, specifically if you're trading currencies and commodities. So we're seeing a series of higher lows coming through for gold. That's continued upwards, and it's continued kind of this strength story that we've got so far with gold. At this point, we're really looking for gold to make a new low under this area here. And that price will be somewhere around 1784. I've been a little bit bearish at this area with gold. I'm still very bullish medium term. I think that we're going into some form of, if not stagflation, we're going to need to see rate cuts. That is a good thing for gold. But when we look at the daily, it's still rejecting these levels. Let's take a look at the weekly just to get a bit of an idea. This week should be very, very telling for what gold wants to do next. If it breaks and closes above, you've got to think drops will be met by huge buy demand. But this week is super important. Long leg doji, long leg doji, long leg doji. They're all indecision or equilibrium points. When the decision is made, we should get a little bit of follow through. As we often say, patience, react, don't predict. This is a very tough period to trade gold, no doubt. If you've got that medium term kind of attitude, maybe it's looking a little bit better. Let's take a look now over at oil. So oil we've spoken about, we thought it would go to around 82 a barrel. It stopped at 81 and then fell off. So it stopped right on 81 and then it fell off. We've got these 82 kind of wick areas. 81 to 82 is fairly fair, I guess, on where the bulls wanted to take it. Let's have a look at the 2 hour. Tough to read this. No new low, so it's not like we can say, oh, we're absolutely going into shorts just yet. If we take a trend line through the bottoms here, you'll notice that it hit that level. Again, no new low. For shorters, you're wanting to see the market break below 77. For longs, you really want to see probably around a 79, 80 plus kind of close. And if that occurs, then we should be able to move back up to 80, 82. So we've got, I would say we've got oil trapped a little bit between price. Let's move over to the biggest discussion in the room, which has to be Tesla. It fell through more than I even thought. I thought we'd probably hit a low of around 113, which is kind of where we are right now. And that was based on a Friday expiration point. I've updated the options expiration for Friday in terms of the implied movements, and you can see here the implied movements according to the options market is a top end of 118 and a bottom end of 106. I think we actually saw about 106 get tested during the post market in the previous session. So Tesla's facing all sorts of problems. There's no way that you can basically say here that you think the bottom's in. I mean, you wouldn't know that. But what did happen over the last 24 hours was we took this low. And because we took this low and we found a little bit of rejection, we have had a stronger day than you would think for Tesla. It kind of like pushed everybody a little bit too far. Most people, including myself, thought between 130 and 123, 126 was a fair level for Tesla. Again, that's more of just a area where you then focus on generally finding some structure. We saw some 15-minute kind of switch potential that obviously didn't hold true. Now we've had a first little rejection in terms of a wick actually going back against the sell-off. Now wicks are key, and we have seen one where it's taken the low. Ooh, I tell you, based on the options, you really should think that Tesla can do it and actually hold this level. Why? Well, it's got to do with where everyone's buying options right now. A lot of puts getting entered into. In fact, the numbers have doubled since the last video in terms of open interest amount. We've got 100 puts. Everyone seems to want those. I don't know what they're doing with their 100 puts, but good luck to them. Then there's 110 puts, and then there's 120 calls. So you can see here, max pain is technically 124. I don't necessarily expect to see that, but we thought about that 120 to 130 previously. I guess I'm going to stick with the idea that markets can get back up above here, even if the other markets are falling, purely because Tesla's probably a little bit oversold. When markets tend to sell this much, they get into this zone where if you have certain indicators, you can kind of tell that there's a bounce coming. Now, should Tesla traders be freaking out? Well, the question is, yeah, I guess they should be because there's a lot to be hating on, but there's 3 million open interest orders for January. And I think this is the strike that everybody's looking at. Look at this open interest 100 puts. Yeah, there's 75,000 almost open interest there. And then there's a lot of still 120 puts, and there's even some 166 puts, which is considerable. So you would think that, again, the markets could stabilize around here. And because they took that low, this is an area very much of interest. We saw the last 24 hours find some buyers. Let's just go back to the Tesla chart here, scroll down to the 2 hour, and you'll notice, actually we'll go even lower. We'll go back into the dirty 15-minute charts, and you'll notice that there were a few buyers coming back through on these charts around this zone. It's mostly just because of the low previously that I'm even paying this attention. But yeah, look, Tesla, it's at critical levels. You would expect buyers to hopefully recommit within the next, well, either here or the next 10%. It's pretty brutal. I'm not sure if this is the low for Tesla. I kind of somehow doubt it if we expect 23 to be worse. But at the moment, traders will be traders. This is one of those ones that's a little bit of a guess. Let's have a look at Apple. Now, I've marked out 123.59 as it's a previous gap close. This is important. This weekly close is massive for Apple. If we end up going underneath that low that was formed in June, this is the biggest stock in the world. And if we do an AAPL versus SPX in terms of a combo, what you'll notice is that we've now broken underneath. So we've now gone underneath a very big structural point. We've basically said Apple is getting compressed on price. The last big juggernaut, the biggest stock in the world, is facing some serious headwinds. And while there may be rallies, you've got to think at this stage, they're probably going to be rallies that are sold. And that's been our general philosophy now for the last 2 weeks. If we get rallies, we generally think they're going to be sold. And a lot of it has to do with some of the stocks going towards key levels. Now, why I mentioned Apple and the gap close has to do with Amazon. 2020 lows, 81.33 or somewhere around there is the 2020 low. The market, I wouldn't be surprised at all to take this low. It looks like Amazon wants to now. It wants to go underneath here, and then potentially some buyers may be recommitted. This will trigger a lot of sell signals, and it will also take out a lot of people's stop losses. Remember what some of these lows mean. They mean stop losses sit behind, and people generally get margined. That's what we've had with Tesla. That's what we're currently potentially getting here on Amazon. So 2020 lows, pay attention to it. Make sure you've got an alert. It may not be for your style of trading, but of course it can help us to build a storyline of where the SP 500 may also want to go. Let's have a look at semiconductors again. Gap closing here to the CPI number. We definitely suspected this would occur. Up here after this candle, we very much felt like semiconductors were going to get shorted. I did want more of a rally. I'm not going to say I didn't. I would have loved to have gotten extra shorts that sat around here and down. It's still possible for that to occur, but what a continuous sell here on semiconductors. And semiconductors are like the best traditional sector to get into. But again, it's valuation concerns. All of these tech stocks are what's really hurting the market. We saw before defensive stocks are doing okay, but tech stocks are just getting absolutely hit. Is this a sell the rumor, buy the fact into Q1 earnings? I think that's something you've got to keep in your mind. Definitely follow along on the channel because we'll be talking about that quite a lot depending on how the market ends up going into Q1 earnings. And that's going to be a blockbuster time for markets. Let's look at the DAX. So the DAX has actually been a little bit more technical. It came up to that first little sell zone. It has so far sold. I wouldn't be surprised at all for the markets to do something like this for the next couple of days. Sideways it up. Make sure they trap all those options monies, which we'll see in a second, and then we'll find out. But I still think that this looks quite short overall, and I still expect that if we do get rallies, they'll be met by sell demand. Let's move over to the US 30, the stronger of the US markets. It's held up okay. We first kind of figured out that this market may have bounced because, of course, we had that beautiful trend line that came down. It hit off that level, and we found those buyers recommitting. What we haven't seen is a new high. So if you're feeling bullish, you really want a price above 33,000, kind of 470 or 500. Once that occurs, you've got to feel bullish about the next couple of sessions, and then ideally moving into something like a 34,000, having some problems in here. There'll be gaps left behind in that area. The Dow, the bigger caps here, clearly a little bit stronger than the others. Let's look at the weak one, the Nasdaq. There's nothing really to like about this. If we have a look at a monthly, which we're about to close, let's load up a 1 month chart. Again, it's down to those wicks. What happens if we get a closure underneath these levels? That's going to be a sad face for many and very scary, because closures are key. And we've had 2 rejection wicks so far, only a few more trade days. The rallies have to start now if they're going to really support a decent January and February for this market. It's not a good looking chart at all. Weekly looks absolutely terrible. There's nothing much to like about it. Dailies come back down to a support, so I guess you could say there might be some buyers here. But I'm starting to think that the SP 500 probably wants to go lower. I still favor, at this time, if you've got shorts in, well, cool for you. But I still would love to see kind of like this, which is that 39.95 gap fill into sell-off. I think it's still possible. Hear me out. I'll explain it in a second. But the other one that I'm thinking about as well is something where the market comes down a little bit further. And I've marked it on this chart. It's a 36.90, where basically the market comes through 37.50, fills the gap that we've got here, keeps selling off, hits a 36.90, and then finds some buyers in here. And you might think, why would it find some buyers in here? Of course, it's just going to continue to sell off. Well, it's partially the type of pullback that it's done and the aggression at which it's done it, and also that it's left a few gaps behind at that point. So if we go over here, we've got a 38.80 and a 39.95-ish kind of gap. I'll put it on the right one, 95-ish. So that's where we've kind of seen a mismatch of probably orders sitting in the markets not being filled out yet. We were very adamant that we could get this one filled. It looks like that's going to come true. Will we get these other 2 filled? And I think it's mostly 2 options. Let's have a look here at this week's expirations. We have pretty much a market that won't want to go under 375. So I think we've probably found close to our lows for this week. We might go under, but by Friday, we have to expect that the market would wish to be somewhere above this. It certainly won't want to go under 365. There's too much money at stake. And as we know, the composite man or Wall Street will not want to pay out all of these options. They generally don't want to. Let's move over to the 20th though. So the first big options expiration is already up to almost 5 million units, and have a look at the stacking of puts. And this is why the market may possibly come down earlier, rally, and then sell later. And it mostly has to do with how many puts are stacked here. Come the back of January, the 20th, this is one of the big options expirations still left with puts all over it. And it's huge. I mean, there's just so many there. We'll have to do a deep dive into what this means. We'll get all of the expected volatilities and everything else out of it. But you can see here, 380s, 375s, 370s, hundreds of thousands of puts just sitting there in comparison to the calls. So the kangaroo style market, or the sideways style market with big moves each way, seems to be the probable scenario here moving into January. What do you think though? In the comments down below, let us know. Let's have a look at Bitcoin. It's probably at an area where it needs to buy. It's pulled back down to this level. It needs to rally through that 17,000 again. Once that occurs, you've got to expect this thing to go to around 17.5 to 17.6. Tough trading in something like Bitcoin at the moment. I still have a pretty negative bias on it. I don't really like the coin at the moment. I still think that this thing can go a lot lower. Check out that weekly. It's just nasty, nasty, nasty. So again, rallies met by sell demand. A lot of this has to do with risk on, risk off assets. And at the moment, Bitcoin, of course, is a risky asset. My general thought process remains the same. I'd like to see it go between 9.5 and 11.5. And there's a few reasons for that. Go back through our previous videos about a month ago, and we went through a huge study of it. So that probably brings us to a bit of a wrap, and we may have one more video out for 2022, so definitely check that one out. But I wanted to say a big thank you to each and every one of you out there that supported us through 2022. We've grown amazingly as a channel, our Discord, our Twitter, and of course, the YouTube. network that we have here with so many passionate traders and investors out there. It's you guys that make this channel what it is. So I just wanted to say a big thank you for liking, commenting, subscribing, and everything else that you've done during 2022. It's been an amazing year, and there's big things to come for this channel for 2023 as well. I have a huge amount of things I want to overlay. I want to bring more data, more information, and more importantly, more helpful stuff that can really, I guess, like educate everybody out there on some of the ways that I perceive markets, and hopefully you might agree with some of those ideas. Thanks so much, guys. See ya next time.